Hey everyone, welcome to day 3 of the bootcamp. In this video, we're going to be going over candlesticks, orders, and all the basics that we need to know to get started with trading before we dive into all the complicated stuff. So the first thing we need to understand is, what are we even looking at? Well, this is a chart, and it's the chart specifically for NQ1 exclamation point. Really random name, I know, but really it is the exact same chart as the NAS 100, as you can see here. The NAS 100 is essentially if you were to list the top 100 tech companies in the S&P 500, which is the top 500 companies in the New York Stock Exchange. If you were to find the top 100 tech companies, specifically in the tech sector, that would give you this asset. So essentially we're combining Google, Microsoft, Facebook, Tesla, all these different companies together into one, and it essentially creates for a very volatile asset. And what I said yesterday was that volatility can potentially make us money. So we're trying to trade a volatile asset, and the reason we are trading NQ1, and you're like, why would we trade something if it's the same chart? Well, the point is that trading this, which is a futures contract for the NAS 100, gives us advantageous conditions as traders. An example would be if I want to buy right here, my broker is going to fill me right here. If I buy here, I get in at the price I ask for. Some brokers with some assets are complicated. I'm sure if you guys have traded other assets, you might have had problems with fills. Here, you will not have a problem. If you buy at 20,000, you will get filled at 20,000, give or take 0.25. That's why we trade this asset. So the next thing we're going to go over are candlesticks. All of this data here is represented with candlesticks, and so we have to understand the anatomy of them. What are we even looking at? So for example, if I zoom in here, we're going to notice we have green candles and we have black candles. And people might have different colored charts, but we're always going to have a different color for candles that go down and candles that go up. What a candle represents is essentially, like I said in the previous video, a minute of data. If we're on the minute time frame, if we're on the hourly time frame, it would represent 1 hour, a day, etc. So in this case, we're on the 1 minute time frame. So each of these represents 1 minute of data and the price movement in that minute. So we have two parts to the candle. We have the body here, which is the rectangular portion, and then we have these parts that jut out, and these are called the wicks. That's where it gets its name, candle, because candles have wicks. So essentially, the bottom here of the candle, since the candle went up, the bottom is where the price opened. So for example, right here, we can see the bottom. We have at 9:48 a.m., this candle would have opened at this price that we see on the right. We can see that this candle would have opened at 21,380. At that price, it opened, and then it proceeded to close at the price 21,391.25. We need to understand the anatomy here, because this candle is telling us a story. It's telling us that price started here, came down, made a low, came back up, made this high, and then closed right here. So I'm going to draw out a candle here, and if it's a green one, then we can almost mark out its motion. So it opened right here, we came down, made a low, did some stuff in between, made a high here, and then came down and closed here. And then this whole portion from here to here is the body, and then what happened down here makes the wick, and then the wick is here. The same would go for a bearish candle, so it's important we understand these things. And just so you guys know, a bearish candle, bearish meaning down, bullish meaning up, a bearish candle opens at the top. In this case, there's no wick, so it just opened and instantly went down. It closes at the bottom because we went from high to low, and then the low is here. So that's the anatomy of candles. Let's go to the next section. So now that we understand a chart, it's important we understand what moves a chart. What makes these candles move? What makes some candles big? What makes some candles small? This is what does it. And you're probably looking at this and saying, I don't know what's going on. And I'm going to tell you right now, we don't even use this whatsoever. But what I will show you is, let's find a particularly large candle compared to others. For example, right here, if we just look from left on, look at all these candles. They're quite small. At least they're quite small in comparison to this one, a very, very large candle. So what's special about this? Why is it so big? Well, one way you can understand it is by turning on volume footprint. Now, we don't need to use this to trade. It's not in the free version, and I don't even use it myself, but it's good to see what's going on. So if I turn this on, volume footprint is telling us where are the orders in the market and how strong are they and how many of them are there. So if we're looking at the numbers here, remember, these were small candles. So at this price level, we had, for example, 75, 69, 130, 33. Green means buy orders, red means sell orders. You can see the delta here. That's essentially telling you how much stronger are the buyers compared to the sellers. But then look right here. Once 9:30 a.m. hits, that's when the market opens, and look at the volume we get. Look at these numbers, compare it to these numbers. Just 173, 300, 200, 187, 151. Compared to these puny numbers, yeah, we're going down. Essentially, the magnitude of how many orders there were in the market doubled, even maybe tripled. And now the reason for that is because the market opened. That's what moves the market. Orders, people buying and people selling. Those numbers represent essentially how many orders there are in the market, and as we can see, we dumped. When we trade, we are actually one of those market participants. We We are a entity placing a trade, and when we place a trade, we're not just placing a trade, we're putting an order into the market. Every time we buy, that's a buy order. We're contributing to the supply and demand. When enough people buy, the market will go up. When enough people sell, the market will go down. What we're trying to predict is when is there going to be more bullish order flow, meaning more buy orders than sell orders. If we can catch on to that, we can start to see maybe, hey, when's this bank going to buy in? Because banks buy a lot of the asset. When is this institution going to buy in? What we're trying to see is when are massive financial entities going to buy, which is going to put buy orders into the market, which is going to push the price up. If we can figure that out, we're going to make money. And that is the formulation for absolutely everything we're going to do. And I'm going to write it right here. We must predict when banks and institutions are going to enter their positions. If we can figure this out, we can make money, because the banks and the institutions are the people with the biggest orders with the most amount of money that are going to push the market. Our puny order for $100 won't do a whole lot, but if 10, 20 million, that's definitely going to do something. And usually when one gets in, another follows, and it cascades. And that's when we get big moves, and we'll start to see how we can predict that. All right, so now that we understand candlesticks and what makes them move, how can we predict our first move in the market? How can we get a sense of when these banks are going to get in? Well, it's all based on liquidity, and the next video is titled liquidity, so I encourage you to go watch that after. There's going to be liquidity part 1 and there's going to be liquidity part 2. There is a lot to learn, but I will get into the basics here because this video is about technical analysis. So like I said, each candle has a high and a low. Every single one, all of these wicks here represent the highest that it was in that period and the lowest it was in that period. But if we look on the grand scheme, we have highs and lows formed just in the market itself. This is a low, this is a low, this is a low, and you get the idea. There are these points in the market where the market came down to here, rejected this area for some reason, went up. We came down, went up, left this low. This was the lowest price got. We came down, went up, came down, went up. And so these lows are being put in. We have the same thing to the upside. We have a high, 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 high. So the market came up, went down, came up, went down, came up, went down, and we're leaving highs. Now, highs and lows are where liquidity rests in the market. Liquidity means essentially, well, think about your bank account. Think about you, for example. How liquid are you? If you are a billionaire with many businesses, you're probably not that liquid. What does that mean? Well, it means you don't have money that you can just turn into cash like that. For example, if I have 10,000 in my bank account, that can be turned into cash pretty much instantly. But if I have my money wrapped in a bunch of different assets and real estate and businesses, I can't just turn my money into cash. I can't liquidate my assets that fast. So that's how you define if someone's liquid. If someone's extremely rich on the billionaires Forbes list, they're probably not very liquid, but that doesn't mean they don't have a lot of money. What it means for the market to be liquid is, for example, an asset like the NASDAQ, that NAS 100. It's extremely liquid because think about top 100 tech companies. This is a very highly traded asset with a lot of orders going through it. So what does liquidity mean? Liquidity means that if we come down to an area of liquidity, for example, let's say I have something marked with a rectangle. Let's say we come down to this area of liquidity. Now, an area of liquidity just represents where are orders most likely to be filled and in high volumes. So there's some areas on the market that won't fill a lot of orders, and there's some areas that will fill a lot. If we can find the areas that will fill the most orders from banks and institutions, that's where we want to get in, because in those areas, there's going to be a lot of transactions going on, and it's much more likely that a bank or institution with tons of money and tons of power to move the market will get in, and we follow them. So how do we identify these areas of liquidity where a lot of orders are going to be filled? Above highs and below lows. Now I'm going to explain why. So pretty much, we have a low here, right? The market came down and rejected this area. Let's say you're a trader, right? So you see the market come down and then whoa, it comes right back up. So you buy. Almost every trader will put their stop loss at the low. So, you're a trader, you get in here. Your stop loss, which I explained yesterday, is when you get out in a loss. So the market goes against you, you get out. Your stop loss will go at the low, most likely. Most traders will put their stop loss here. And so let's say you're holding this trade and you're expecting the market to fly up, right? But no, it doesn't. It comes back down, and look what happens. You get stopped out. Your order is sold into the marketplace. You bought here and you're selling here. But you're not just selling to the middle of nowhere, you're selling to someone. Every time someone buys, someone's selling to that person. Every time someone sells, like you here, you're selling your share or you're selling your unit of this asset in a loss, someone is buying it back from you. That's how the marketplace works. So when you sell your share, someone is buying it back from you. You want to do what most traders don't do. Most traders fail, and what they're going to do is they're going to buy here, going to get stopped out, and a bank or institution will buy back their share and make the market go higher. What the banks need, because a bank can't fill a $1 billion order like that. We have the privilege to just buy an asset and instantly get filled. Like I said, any entity needs people selling the shares to them to buy their shares. The market will hunt these areas of liquidity, i.e. lows, because people put their stop losses here, and a lot of people are getting out of the market here and under this area. So when a lot of people are getting out here, it creates an area of liquidity, an area where lots of orders can be filled. The reason is lots of people are selling here, and that gives the banks the possibility to buy billions worth of shares to send the market higher. The bank can't just buy them anywhere. They wait for people to fail, traders like us, so that they can buy. So we need to understand their strategies and how can we follow them? How can we not get caught like this trader and instead be the trader that gets in after? That'll be in part 2. So I hope that's an exciting concept. That's the concept of liquidity. The basic idea here, guys, is that liquidity rests above highs and below lows. And the reason it also rests above highs is because it's just completely the opposite. The market works the same up as it works down. So let's say you're a trader and instead you go short. Yes, you can make money when you sell an asset. If you short sell and the market goes down, you'll make money. So I often take longs, sometimes I take shorts, which means I buy or I sell. I just go based off where I think the market's gonna go. If the market's telling me it's gonna go lower, I short sell and I'll make money if it goes down. If I think the market's gonna go up, I'll buy, I'll go long, as they say. So let's say you're a trader and you go short right around here. Well, there's a high right here. So you're gonna put your stop loss right there. You think the market's gonna go much lower. And so what happens? You put your stop loss at the high, and you and many other traders are buying back your positions in a loss right here. When you buy back your positions, that gives banks and institutions a chance to take your order and use it against you. You sell your position in a loss, they'll buy it back from you and sell and make the market go lower, because now they were able to fill all their orders in this area of liquidity above this high, and they were able to send the market lower. So I hope that makes sense. In the next video, we're gonna get a lot more deep into it and how we can actually start predicting the market this way. The only thing I really need you guys to understand is that major lows, below that rest liquidity, and what you'll often see is the market just take people's stop losses out and reverse. And that is the whole formulation of how we're going to trade. Above these highs here, what do we have? Stop losses get raided, pushed down. It happens yet a second time, and the market pushes down. Then what happens? We have a low right here. People who went long here, their stop losses just got raided. We push the market down a little more. We come back up, get the actual move. Once again, low right here. We come down, we take out this low. That's how we say it. We take out the liquidity, come down, do it once more, faking out even more people, and then we get the actual distribution. So that is the basics of technical analysis, order flow, and candlesticks. And yeah, so that's pretty much it for the video. We're gonna see you in part 4. Thanks for watching. Yes, sir.